Hello dear students. Today we will be doing question number 10. Here, Deepa, Jyoti and Geeta are the partners sharing profit and loss in the ratio of their capitals. That means their capital balance is 1 lakh, 1,50,000 and 1 lakh. So according to these capital balances, their ratio would be 2:3:2. Here it is given that Jyoti retired on the date 31st March 2017. Here some terms and conditions are given and we have to prepare revaluation account, partners capital account and new balance sheet, that is balance sheet after retirement. So let's start. So here we will prepare revaluation account, partners capital account and balance sheet as on 1st April 2017 after retirement. So let's start with the first point. Here in first point it is given that new profit and loss sharing ratio of Deepa and Geeta is to be kept at 1:1. That means new profit and loss of continuing partner Deepa and Geeta is 1:1. Then goodwill of the firm is given, that is 17,000. So here we will obtain share of goodwill of retiring partner, that means goodwill receivable by retiring partner Jyoti. So here according to the old ratio, that is 2:3:2, goodwill receivable by Jyoti will be 70,000 multiplied by 3/7. That means 30,000. 30,000 is Jyoti's share in goodwill. So this goodwill will be given by Deepa and Geeta in their gaining ratio. That is, if you solve it, you will get, by applying the formula of gain, that is new share minus old share, you will get gaining ratio, that is 1:1. That means goodwill of Jyoti will be given by Deepa and Geeta in their gaining ratio, that is 1:1. So let us give effect of that. Here Jyoti's capital account will be credited by rupees 30,000 as Jyoti will receive 30,000 from continuing partners. Out of 30,000, Deepa will give 15,000 and Geeta will give 15,000 according to gaining ratio, that is 1:1. Then Deepa's capital account will be debited by rupees 15,000 and Geeta's capital account will be debited by rupees 15,000. Now second point, bad debt reserve on debtors is to be reduced up to 10%. If you see in their old balance sheet, debtors is shown at rupees 40,000. So if we calculate 10% of 40,000, we will get 4,000 as new amount of bad debt reserve. And in their old balance sheet, bad debt reserve is already shown at rupees 6,000. On comparing new amount of new bad debt reserve and amount of bad debt reserve which is already shown in their old balance sheet, we can see that here amount of bad debt reserve is getting reduced. So we will give effect. First effect will be on asset side of balance sheet. Here debtors is 40,000 and if we deduct bad debt reserve, that is 10% of 40,000, that means 4,000, we will get 36,000 as amount of debtors in outer column. And for its second effect, as the amount of bad debt reserve is reducing, so it will be considered as gain for the firm, and so it will be recorded on credit side of revaluation account. So here we will write by bad debt reserve account amount 2,000 Here amount of bad debt reserve is getting reduced by rupees 2000. That means 6000 minus 4000, that is 2000. Third point, stock is shown in the books at 25% more than its cost. Stock to be recorded at cost. Let us see working note for stock. Assume cost of stock is equal to 100 and it is given in the question that stock is shown in the books at 25% more than its cost. That means 100 plus 25, which is 125. That means on 125, if the amount of stock is 50,000, then what will be the amount of stock at 100%? By cross multiplication, we will get 40,000 as cost of stock. So here in the balance sheet, we will record value of stock as 40,000 in outer column. That means 50,000, which is shown in their old balance sheet, minus 10,000. Here we have obtained new value of cost, that is 40,000, and 50,000 is already shown in the old balance sheet. That means here differential amount, that is 10,000. It indicates that value of cost is reducing. So let us see another effect. Now its second effect will be on debit side of revaluation account, as stock is an asset and value of it is reducing by rupees 10,000. So it will be considered as loss. Now next point. Point number 4. 60,000 is paid for trademark during current year, which is for total 6 years. Here value of trademark is given, that is 60,000, but it is for total 6 year, and we prepare balance sheet of 1 year. And so here value of trademark will be proportionately written off every year. That means we need to find out value of trademark to be written off for every year. So how we are going to find it out? Here we will divide 60,000 by 6 years. So we will get 10,000. So 10,000 will be written off every year. So here on asset side, trademark will be shown as in the inner column, 60,000 will be written and 10,000 will be written off. So in outer column, we will get 50,000 as the value of trademark. Now next effect, its second effect will be on debit side of revaluation account, as trademark is an asset and value of it is reducing. So we will show it on debit side of revaluation account. So here it is, to trademark, amount 10,000. Now next point. Point number 5. Liability of Provident Fund is decided at rupees 35,000. In their old balance sheet, Provident Fund is shown at rupees 32,000. Provident Fund is the liability for the firm due to employees towards Provident Fund. And here new value of it is decided at rupees 35,000. So in balance sheet, in our new balance sheet, in outer column, we will show 35,000 as the new value of Provident Fund, and as 32,000 is shown in their old balance sheet, that means 35,000 minus 32,000, that is 3,000, is it indicates that the value of Provident Fund is increasing. So it will be recorded on debit side of revaluation account to Provident Fund account 3,000, as it is a liability for the firm, and since its value is increasing, so it will be considered as loss for the firm. That's why it will be recorded on debit side of revaluation account. Then next point, total capital of the new firm is to be kept as the total capital of the old firm. That means total capital of the new firm will be the same as the total capital of the old firm. And total capital of the old firm is given in the question in balance sheet. It is given, that is 3,50,000. And it is given that Deepa and Geeta, that means continuing partner, will maintain this capital in their new profit and loss sharing ratio. And their new profit and loss sharing ratio is 1:1, which is given in point number 1. So according to new profit and loss sharing ratio, that is 1:1, 3,50,000 will be distributed as 1,75,000 to Deepa and 1,75,000 will be the capital of Geeta. So here we will write to balance carried forward, that is closing capital. 1,75,000 is Deepa's closing capital and 1,75,000 is Geeta's closing capital. Now let us record the remaining items from old balance sheet. First, opening capital balance will be recorded on credit side of partner's capital account. Here it is. Opening balance of capital balance of Deepa is 1 lakh, then 1,50,000 of Jyoti and 1 lakh of Geeta. Then general reserve is given, which will be distributed among all the partners in their old profit and loss sharing ratio. That means general reserve, that is 28,000, will be distributed according to old ratio, that is 2:3:2. So as per that distribution, Deepa will be given 8,000 and Jyoti 12,000 and 8,000 for Geeta. Then creditors is given, so it will be recorded on liability side. Here it is, creditors amount 60,000. Then provident fund we have already recorded. Then let's move to asset side. In asset side, goodwill is given. Goodwill is appearing in their old balance sheet, that is it is old goodwill, which will be written off according to old profit and loss sharing ratio. So here goodwill account will be closed and it will be distributed to old profit to all the partners in their old profit and loss sharing ratio. So it will be recorded on debit side of partners capital account. So in Deepa's column we will write 4,000, Jyoti's column we will write 6,000 and 4,000 of Geeta. Then land and building will be recorded on asset side. Here it is 2,90,000. Then trademark we have already recorded it. Then stock we have recorded it. Then bank balance is given, which will be shown on asset side. Here it is 22,000 bank balance. Now we will close revaluation account. If you close it, you will find difference on credit side, which is revaluation loss, that is 21,000, which will be distributed among all the partners in their old profit and loss sharing ratio, that is 2:3:2. So according to this ratio, 21,000 will be distributed as 6,000 to Deepa, 9,000 to Jyoti and 6,000 to Geeta. Now this revaluation loss will be transferred to on debit side of partners capital account. Here it is, revaluation account, 6,000 in Deepa's column, 9,000 in Jyoti's column and 6,000 in Geeta's column. Now it's time to close partners capital account. Now if on closing partners capital account, if you find difference on credit side, it indicates that that partner has brought in further capital to make up deficit of their capital. And if you find difference on debit side, then it indicates that that partner has withdrawn the excess capital. Now as it is given in the question that the difference is to be transferred to their current account, that means here capital is to be adjusted through partner's current account. So when you will close Deepa's capital account, you will find difference on credit side, that is 92,000. So here in particular column, we will write by current account. And if you close Geeta's capital account, then you will find again difference on credit side, that is again 92,000. So here also, that means here both the partners have brought in further capital to make up deficit of their capital. And as it is given that the difference is to be transferred to their current account, that means capital is to be adjusted through partners' current account. That's why in particular column we will write by current account. Now we will close retiring partner Jyoti's capital account. Here, the balance obtained by closing the retiring partner's capital account is the amount payable to the retiring partner. But here, the question is silent in respect of payment of Jyoti. Therefore, the amount due to Jyoti will be transferred to her loan account. So here it is. Here difference will appear on debit side, which will be recorded as to loan account, which will be transferred to her loan account, that is 1,77,000. Then on liability side, we will show Jyoti's loan on liability side in balance sheet, that is 1,77,000 Jyoti's loan account, and their current account balance will be shown on asset side. Here it is 92,000 of Deepa and 92,000 of Geeta. Total in outer column, that is 1,84,000. And your balance sheet will be tallied with the amount of rupees 6,22,000. So here we have completed question number 10. That's all for today. Thank you very much.